Okay, rather than making this lecture on my iPad, I'm going to try making this video on my desktop. I won't be able to like draw anything, but if anything comes up, we'll figure it out. So in this chapter, what we're really doing here is we're just providing the broadest of overviews of what the financial system looks like, what it is. I'm just going to skip over these objectives, again, presuming that you can read them. But essentially, what financial markets do is they find connections. They make relationships between those who are savers and those who are borrowers, because that's where we need to move the money between, right? People who have money to invest, or institutions that have money to invest, and individuals or institutions that need funding of some kind. And one of the initial differences we can draw here is the difference between direct finance and indirect finance, which I'm not sure why they don't define it here. But imagine direct finance as basically a direct way of linking borrowers and savers. So we have some examples of these. Let me just give you two examples. So this is a bit of an extreme example, but you can get the idea here, right? Is that U-Haul has lots of trucks, lots of equipment, and they need money to finance their operations. Now, they could go to a bank, they could go to the financial markets and issue bonds, but what they've decided to do is they've decided to create this website called UHaulInvestorsClub.com. And what they basically, by creating this web portal, you can buy a bunch of trailers. So these two are already the furniture pads, right? Furniture pads, the blankets, dude. They had how many? Over 2 million furniture pads, and they needed $1.75 million for all of it. And people put up the money. It's a 2-year loan, basically, paying 1.75% interest. Everyone did it. So it's not, I guess one reason why this might appeal to a direct investor is, we've probably all used U-Haul at some point in our life. So we know what trailers look like. We know what furniture pads look like. We can see the interest rate, and we can see how long the time period is. The note, the U note. This one is for the trailers. They need $200,000 for 365 trailers. And people put up about $77,000. Now, there's a benefit. Oh, let me give you another example of, before I talk about. So one example that's a little bit more legitimate. It should be opening, but I'm not sure why. Well, it might be just the time of day. Maybe it's unhappy. It's the time of day. Anyway, you can buy also U.S. Treasuries direct from the federal government. You can go to treasurydirect.gov and you'll see various bond offerings and what the interest rate is. Now, and obviously it's not working right now, but you can log in treasurydirect.gov and you see the same thing, that the government has this. You can buy U.S. Treasuries, U.S. government debt, both directly and indirectly. In the direct fashion, you're not paying any commissions. You're just buying it direct from the source. Now, the problem with Treasury Direct, the problem with this U-Haul Investors Club thing, well, there's a benefit and a negative consequence. The benefit is that it's cheaper. I don't want you to focus on easy to understand, although it is. It's obviously a bit subjective. Um, but the idea is that it's an incredibly cheap way to invest some money. Whether it's an appropriate investment or not is undetermined. Same with treasurydirect.gov. You can buy those treasuries, that offering, with no commissions. But whether it's appropriate or not is undetermined. I say this because, especially in this kind of industry, the financial industry, people get really upset about commissions, but commissions do serve a role. As a sort of example here, so my wife is in finance, and her position is almost entirely commission based. Now, she has clients who probably on a weekly basis complain to her about what her fees are, what her expenses are. And in some sense, it's good, right? Because people are conscious of what the expenses are, that there are expenses to what's being offered, that it's not free. But the argument she makes, and the argument I would make about why someone might want to be cautious before using U-Haul Investors Club or Treasury Direct or any really direct method of finance, is that you lose counsel, meaning you lose the ability of a third party to say, is this the appropriate investment? Is this the legitimate need? Is this due diligence being done? Just like, right, if you hire a real estate agent, the benefit you get is that they ensure that the transaction proceeds smoothly, right? And that everything being represented by either the buyer or seller is actually what is the case. And you have someone you can sue if that's not the case. Just like someone could sue my wife if the investment was bad and she said something that wasn't true about that investment. Here you don't have those kinds of protections. All they're saying here is, do your homework! Exclamation point. Yes, it is important to do your homework, although why? So I don't participate in this. I wouldn't know enough to buy this. I can't imagine all the trailers are of equal age. Who pays for the maintenance of these trailers? What happens if someone doesn't return it? I mean, there's so many ways in which I could read this prospectus, I guess. I've never done this, but let's just see here. Oh, you want me to download it? Jeez. Okay, I'm not going to do that. And yet I'm curious. Fine. I'll look at it really fast. Americo. The trustee is U.S. Bank. I see. Oh, how interesting. So if you read this document and you know a little bit here, you're actually not buying those trailers. It's a lien. It's a first priority lien on those trailers. So they've bought those trailers in some other fashion. They just need the whatever, $200,000 or whatever. So they're saying, if we don't pay it back, you can have these 365 trailers. That's the collateral. Well, fuck, dude. I don't want 360. What would I do with 365 trailers? That's good. It's not deceptive, but I mean, it does say name of collateral, description of collateral. But you're almost left with the initial impression that they're taking your money and they're buying trailers in some sense or keeping them going. It's not. It's just if we don't pay our bills, you can have these trailers. You'd have to obviously read that prospectus in a lot of detail here and really get a sense of what's going on here. 22 pages that you need to be, I guess, doing your homework with. That's pretty intense for the interest rate you're getting paid. U.S. Treasuries, you don't have to do as much homework. The only problem there would be, should you be putting your money in U.S. Treasuries or should you be buying some other kind of bond? What financial markets do that make them so great is that they ensure that capital is allocated efficiently. That is what they do. They ensure that those who need the money will get it. What's beautiful about capital markets when they exist is that if someone has a good investment idea, they will get the funding for it. Even if they don't have collateral, even if maybe they've missed a payment or two of some kind, they will get the money. Because all they have to do is just raise the interest rate. As long as there's enough capital out there and there's some assessment of the risk, they will issue a loan of some kind. Look at restaurants, right? Restaurants are the business that fails most often, yet restaurants still can get money. They just pay a higher interest rate to borrow that money. And what's good about financial markets is that they allow the economy to grow. Financial markets permit capital investments to be made, and it's those capital investments that help the economy grow. So what we've now covered is the dark blue part of this flow of funds from the lenders and savers directly to the borrowers, spenders. Right? That I in the yellow as a household can log into U-Haul Investors Club and basically lend my money to U-Haul. A risk, but again, as I said, cheaper, but a bit riskier. Most of us actually deal with an intermediary. And the benefit to that intermediary is that you do get then some comparison across different investment types or different options of how to use that money or whether an investment is appropriate. You get counsel, you get years of experience. My wife's been in the industry since 2008, right before the crisis happened. So she's obviously got 13 years now experience. That says something. That does something for an investor, I would think. So we've got indirect and direct markets, but then we also have primary and secondary markets. And with the primary and secondary markets, again, the difference between those, as I had already kind of mentioned, in the primary market, if I am buying a bond in the primary market, the money that I use to buy the bond goes directly to the agency that's issuing the bond. Meaning, if I put down $10,000 for a Board of Water Supply bond, the Board of Water Supply gets that $10,000. In the equity markets, you would see this in an IPO. On the day of an IPO, if you're buying the stock for the very first time, the company gets those proceeds on that first sale. Most of the time, most of us are dealing in secondary markets. If I, now the owner of the bond, decide then to sell it to someone else, I get the $10,000, not the Board of Water Supply. And if I want to buy a stock, I'll probably be buying it from someone who already owns it. That will be a trade of some kind. when you're trying to make your choices among these kinds of different financial options, you're really comparing different maturities with different interest rates. And when you're looking at equities, you're looking at dividends. What's the payout going to be from their flow of income? Now, when we think of the equity markets, here we're dealing with exchanges and over-the-counter markets, OTC markets. Let's start with exchanges first. The exchanges, that's what you would kind of see on TV when people are yelling at each other and whatnot. The NYSE stands for the New York Stock Exchange, and that would be trading of securities. And that's where you see either computer trading of some kind or individuals yelling at each other for sales. The most classic kind of exchange is the Chicago Board of Trade, which you have agricultural products for the most part being traded. And that's an incredibly active trading floor. The pandemic has sort of changed everything. You don't actually, I think the Chicago Board of Trade is now no longer going to do active trading in that kind of way. But the exchanges would be, you've got a broker standing in the exchange, and some of the brokers represent buyers, some of the brokers represent sellers, and you just, two brokers are saying, hey, I represent this buyer and they're willing to pay this. And this other one says, my guy is willing to sell his for this, right? And you hope to strike a deal. Over-the-counter markets, you see these with foreign exchange, you see these with federal funds, and over-the-counter markets are more lightly traded. So the prices are less negotiable, and they fluctuate a little bit more. And then we've got our difference between, when we're talking about finance, we basically have money markets and capital markets. The money market, many of us have actually this kind of investment unknowingly as our savings account option at our local bank. Money markets are basically short-term treasuries, short-term investments that pay a slightly higher interest rate because they're just slightly less liquid. The big deal in the financial crisis of 2008-2009 was when money markets, a dollar was no longer worth a dollar. That's how bad the financial crisis was, is that the capital markets were basically collapsing, even for short-term debt. Money markets are called money markets because it's highly liquid. It's not 100% liquid like cash is, but it's highly liquid. So it's very darn close to money. Capital markets are less liquid. It's longer term debt. It's longer term equity instruments that are a little bit harder to unwind. And so because it's less liquid, it's called capital as opposed to money. So if we look at what's all going on here, in terms of the money markets, most everything out there would be the security repurchase agreements. These security repurchase agreements reflect an agreement to buy a security if it should fail to trade. And so you need some financing for a few days. Whenever a security is traded, like if I buy a stock, it has a few days to clear. You need some financing to finance that purchase until the money goes through. That's what you're seeing right there. Commercial paper, that would be corporate issued bonds of some kind. Bank certificates of deposits, these would be basically very large CDs that banks offer. And U.S. Treasury bills. This would be U.S. government debt, probably 90-day maturity or less. And then if we look at the capital markets, well, the biggest, not surprisingly, would be corporate stocks, which this data here is from 2016. So you'd have to imagine that it's grown significantly larger since then, which we could look up if we wanted to, but it's not as important right now. Then we've got corporate bonds and U.S. government securities of longer date. Then you've got mortgages, right? So most of these, the title should be pretty obvious. Corporate bonds would be a company needing to borrow money and so issuing a bond directly, maybe with collateral, maybe not. U.S. government securities, this would be U.S. government debt, long term, so this would be probably a 30-year bond. Certainly a 10-year bond, but probably up to 30 years. Residential mortgages, these would be, home purchase. And then you've got state and local government bonds, bank commercial loans, and whatnot. Financial markets are obviously global. You can have foreign bonds, foreign currencies, foreign stock markets. My wife and I don't fight a great deal about many things, but I'd say the one thing we end up disagreeing probably the most about is the appropriateness of an investor being having global exposure. She believes it's essential to a well-diversified portfolio. I agree with that assessment. I would say my biggest issue is I have not seen a really good way that someone gets that exposure indirectly. And I don't have the time to do a direct investment in a international market. I say that because obviously we all know one country very well, right? Either the United States or wherever, the country we consider home. That's probably the one we know the most. And yeah, I can look up Wikipedia. I can look up what's going on in Zambia, just like the next person. But I'm not sure I know enough to know what I should be investing in Zambia. And why am I doing it? Well, the one idea is, the U.S. is growing slowly because it's a very mature market. Other markets are growing much faster. I don't doubt that. But it's a great deal of risk to take on, and I'm not sure what the benefit is to doing it. Well, the reason why capital markets are international is that oftentimes there's not enough money internally to finance things. So the U.S. obviously issues a lot of debt. There's no way the United States would be able to completely fund that debt. So fortunately, global demand for U.S. Treasuries is high. And so those bonds are being purchased. Japan issues a lot of bonds. And actually a lot of Americans buy those bonds. As I said before, the benefit to the indirect finance market is, in my opinion, less risk. You have the counsel of someone else to tell you what risk you're taking on, that there is that diversification that comes from, let's say, like a mutual fund or something like that. And By engaging in indirect finance, you can get some lower transaction costs by virtue of the fact that your money is being pooled with others to buy shares of Google that you yourself wouldn't be able to afford, as one example of a high price stock. Indirect finance is useful as well for two of the big information problems that plague financial markets, and that would be adverse selection and moral hazard. In adverse selection, the problem we have here is that is it the case that only, let's say if someone needs money, is it just because they're desperate that they need the money, or are they getting the funding just as a precaution? Well, in indirect finance, at least you have some protection that you're not getting bad players because they would have experience with whether they've dealt with that party before in the past or not. They'll, make an opinion about that debt, or they'll have an opinion about whether you should buy that stock. And then we've got moral hazard. Moral hazard then is where you know that once someone gets the money, that they're doing what they said they would do with the money. So for instance, if I buy a car, the bank, and I need a bank loan, the bank doesn't usually give me the money directly. They give the money to the dealer, right? And they put their name on the title as a way to protect themselves. And that's because of moral hazard. In this case, in indirect finance, a mutual fund, if it was buying a bond, would want to make sure that bond, what it said it was being used for, that it's actually being used for that, that the finances are appropriate. As an example of that, for instance, back, I don't know, maybe about 5 years ago, when there was concern that the state of Illinois, city of Chicago, wasn't going to be able to make bond payments because of pension obligations. My wife's firm, for instance, got involved and said to investors, sell whatever you have of this because they're not doing what they said they were going to do. You can do that in indirect finance because they have the time. There are firms that have the time to investigate whether that's happening. In direct finance, people just wouldn't know. And so what we see as one of the benefits of indirect finance with things like mutual funds is that it's really opened up the markets to others. And you can get, basically, as this conclusion states here, you can get small savers to have some participation in the markets. It's not just for rich people. When we look at it from a banking perspective, commercial banks, savings and loans, mutual savings, credit unions, all these accept deposits. And then they use that money for either mortgages, other kinds of consumer loans, or more broadly speaking. So for instance, Bank of Hawaii, First Hawaiian would be commercial banks, as opposed to Navy Federal Credit Union, which basically makes loans to its members. Or even Central Pacific Bank, which is more of a mutual savings bank than it is a commercial bank. Or Territorial Bank, which is a bit more of a mutual savings bank. Or even American Savings, which isn't necessarily a savings and loan, but is more of a mutual savings bank. Then you've got insurance and pension funds. Let's start with the insurance companies. You've got life insurance companies like Prudential. You've got, it's kind of an old term here to say that you have fire insurance, but think this is just such a odd. It's a really dated. Yeah, it's just hard to find. I think there's actually a really big company out in San Francisco. I mean, the reason why it's a little bit old is because most people have fire insurance by virtue of having their homeowner's insurance. Um, yeah, it's just saying. Yeah, I mean, I guess like wildfires and stuff like that. Um, Fire insurance is just extra coverage. I was just trying to think though. There is. It's such a defined market that there is like one company that has a lot of the business of fire insurance, and I just don't see it listed here. Anyway, it doesn't matter. Casualty insurance, that's like other things going on, like homeowners or renters policies. What these do is they collect premiums from all of us who have those policies. They take those premiums and they're forced to, by the various states that regulate them, to invest in bonds and mortgages and whatnot. And then as claims come out, they pay those using those assets. And then you've got like pension funds. Again, as I kind of mentioned in my previous lecture, I belong to the employee retirement system of Hawaii. I put in 9%. My employer is supposed to be putting in 20%. And together, the ERS uses that money and makes various investments. Then you've got finance companies, mutual funds, money market funds, hedge funds. Mutual funds are probably the ones that you and I would all be probably the most aware of. Mutual funds are not like ETFs, exchange traded funds. Mutual funds are basically actively managed, meaning that someone says, let's say I'm going to start a tech innovation mutual fund. Well, then I'm going to go out there and I'm going to look at businesses and find which ones are being the most innovative and make selective investments in what I think is the best kind of thing. So I'm going to get money then by selling shares, take that money and then buy stocks and bonds in those innovative companies. As opposed to money market mutual funds where someone gives me $1 and I basically invest it in something that is highly, highly liquid and might pay $1.01, and I get to basically collect that 1 cent difference just because it's so liquid. And then you've got finance companies. Finance companies, they issue loans to consumers, to businesses, and they're getting their money from investments in paper, commercial paper, which again is another way of saying some sort of commercial loan, stocks and bonds. Hedge funds are a little bit more extreme. Hedge funds are complicated, but basically you put up an investment in a hedge fund. The hedge fund then restricts you from withdrawing that money, and they make a bit more exotic investments in things that might pay off very big. Then, if we look at how big these various parties are, well, most money exists in commercial banks as opposed to credit unions. I know credit unions seem pretty important here in Hawaii, but that's because we do not have any commercial national mainland commercial banks here. So we have basically a locally grown banking system here that relies on credit unions. With Navy Federal Credit Union actually being the largest credit union in the United States. And then in the insurance side of the business, private pension funds are pretty large, but they're obviously decreasing in size. State and local government retirement funds, pension funds are large, but are decreasing in size. Most everything out there that's really big is really in life insurance. That's still actively large. And the life insurance business is pretty competitive in the United States. Then mutual funds, it's decreasing actually a little bit now, more over time, because you see things going more to exchange traded funds, which are more passively invested mutual funds. But activist mutual funds are decreasing in size because of how expensive they are. As an example of this, if we go to Vanguard, which is probably probably most of you are somewhat aware that it exists. You can see here again a distinction made between mutual funds and exchange traded funds. Vanguard is known most for its exchange traded funds, which we'll talk about what they are in a bit. But basically in an exchange traded fund, I guess I could just read this to you, but the basics of an exchange traded fund is that they are incredibly cheap because you really don't need any special knowledge to create an exchange traded fund. You could just say, in this case, what Vanguard does is there's a index known as the S&P 500. We know what the 500 companies are, and basically Vanguard says, okay, cool, we'll buy shares in each of those 500 companies. It is their largest ETF. Just wait for it to load here. And that would be this right here. Look how cheap that is. That's not even 1%, right? That's right, in this case, 0.03 of a percent. Incredibly cheap. Incredibly cheap. But again, it's just buying the 500 things out there. So there's not really a lot of of knowledge really required to carry this out. I mean, management, I could find the 500 things. I don't know why it says 507. Maybe it's catching some that just got taken off the list or something like that. But they've got $176 billion invested in this. And they really don't have to think too much about it because we know, right, these are the big holdings, these are the big companies on the S&P 500. As opposed to mutual funds, where now you've got a bit more going on in terms of professional management. And as a consequence, you could have things like U.S. Growth Fund. So now it's going to be more professionally managed. They're going to try to get the highest growing kinds of companies, but now my expense ratio is more expensive. It's more expensive to do this. But it's Vanguard, so it's still going to be pretty cheap. Now, the financial system is regulated. It's regulated by the Securities and Exchange Commission to try to reduce insider trading. As we said, the financial intermediaries try to get involved to try to reduce adverse selection and moral hazard. We have other things going on as well. We have things like the Federal Deposit Insurance Corporation, FDIC, which ensures that bank runs are kept to a minimum. We have regulation of the banking system by the Federal Reserve and by various state banking agencies. Banks are limited in what they can invest in. They have to disclose certain amounts of information. They have to ensure that they're lending in an equitable fashion. All these are parts of ensuring that the financial system operates soundly. Oh, we got the CFTC, sorry. We also have the Commodities Future Trading Commission, which is basically managing the exchanges. We have the comptroller of the currency. That would be the national government regulatory body besides the Federal Reserve that ensures that banks are doing what they're supposed to be doing. We have the NCUA, the National Credit Union Administration, which is actually based out of Madison, Wisconsin, which ensures that credit unions are doing what they're supposed to be doing. Again, as I said before, we've got the state banking and insurance commissions. We have the FDIC and the Federal Reserve System. Okay. It gives you a bit of an overview now of the financial system itself, which now will lead us to then talking about what money is in the next chapter before we have an exam.